Hi, everyone. I know something that a lot of people struggle with is stock research. Now, I've done 2 videos on the financial statements, but that's a very small part of doing research. When I do stock research, I study the business. First and foremost, I study the business. So I thought I would do a short video, while markets are down, while everybody is stressing themselves out. I thought, let me just put something together so that you guys can help yourselves over the next couple of months, weeks, etc. This video is not going to be perfect, but what I'm going to try to do is explain to you how to study the business, not the financials, not leadership, etc. I want you to know what the company is doing. I have 9 questions that I ask myself, and I'm going to quickly break them down. So in no way, shape, or form is this a final, that I'm not going to dive into any of these topics later, but let me quickly go through what my universal research template looks like for any company, whether it is a JSE stock, an Australian stock, a NASDAQ, on the NYSE, any company on earth. So let's dive right in. I spend 75% of my time on the Moat. Moat doesn't stand for anything. Moat is a word in the English dictionary, and I'm going to explain it. We only have 2 slides. I'm going to explain it in the next slide. So I spend, if I have an hour, 45 minutes is studying the business. Then I spend about 15% of my time. This is no exact science, but I want you to look at how important each of these items are. I spend 15% of my time on the financial statements. Now we have 2 videos. I'll pin them again. The financial statements themselves, understanding what a set of financial statements looks like, and then also looking at the ratios and being able to compare one company to another. Then I spend about 5% of my time on valuation. In the second video on ratios, the only 2 metrics that I look at are the price to sales ratio and the price to earnings ratio. And I've explained that in the previous video. You can just refer back to it. Then I spend a bit of time understanding leadership. Guys, these are the people we appoint as shareholders. You might think I only have, 1 share, but shareholders appoint leadership, and leadership is very, very important in the future of the business, if a business is going to make it or if a business is not going to make it. So there's a few things. I will do an entire recording, probably 4 to 5 minutes, on just showing you how we study leadership. It's not going to be today. And then the thing that matters the least in my life, and where I think a lot of people, especially new investors, spend a lot of their time, is on the share price. So I spend 1% of my time. So if I have 100% an hour, the least amount of my time is spent on the share price. The most time is spent on understanding the business. What I've done wrong when I started investing, and what a lot of new investors are doing wrong, is they spend 99% of their time on, let me just grab my laser pointer. They spend 99% of their time on the share price. They look at a chart and they say, this share price is gone down 90%, it can't go any lower, and they invest. You've ignored 99% of research. You also look at a share price, and this is also a mistake I've made. When I started investing, I look at a share price, Amazon, I looked at it at $1,500, and I was like, it can't go any higher. So this is a very good indication of where you should be spending your time in terms of stock research. Now let's jump into today. In this video, I just want to focus my energy on the Moat. So let's look at the moat. What is a moat? Moat is an English word. Warren Buffett brought this word into investing. It's an English word. It's in the dictionary. If you look it up, the moat is, if this is a city or a castle, around the city, there's this water. And sometimes they would even cover the water with like leaves and things just to make it more, that people can't see it. That is the thing that protects your investments. And Buffett brought this word into investing, and he said, he won't invest without a moat. So what is going to protect your company from attackers? He wants to know how deep or how shallow or how non-existent is the moat. We're never going to find a company with the perfect moat, but the deeper that moat is, the better the chance that that company is going to be protected from attackers. Who are these attackers? Attackers, it's happening right now. There's a war going on. We've got interest rates rising. Inflation is out of control. It's competitors to your company. These black swan events, that's all the attackers. Okay, so let's go through the questions that you need to ask yourself and that you need to answer before you invest. The first question I want you to answer is, does the company sell a unique product or service? This is looking at competitors, and a lot of people answer this question off the top of your head. I don't want you to do that. It could be a company as simple, if you're a South African investor, it could be a company as simple as ShopRite. If you answer this question and you say, no, ShopRite sells groceries, it sells, it sells clothing, it sells appliances. The question is not, does the company sell a unique product or service? It's not asking you if the product or service is unique. You need to go and dig and see, is there something that ShopRite is doing differently from their competitors that gives them a competitive advantage? So you have to dig. And if you study ShopRite and you study its strategy in terms of how they mix low income, middle income, high income, with the different brands that they have, how they incorporate financial services, etc., etc., you cannot answer this question off the top of your head. You have to dig. So any company, whether it's something as simple as Apple, Amazon, ShopRite, Woolworths, dig. The next question is, how easy is it to copy what the company does? We always keep competitors in mind, okay? If it's easy to copy what your company does, the moat is shallow. So if we have to answer this question for Tesla, a lot of people who will answer this question and they will say, hey, your electric cars, it's very unique, and they will score Tesla high. I would not score Tesla a perfect score on this, because I would say, let's look at BMW, let's look at VW. If I was them and I buy a Tesla and I reverse engineer that thing, and I have access to the world's best software engineers, electrical engineers, all types of engineers and scientists, I reverse engineer a Tesla and I put it back together and I slap a BMW badge on it, and that's going to get us to our next question, and I slap a BMW badge on it. It's not that hard. Also think of generic medications. It's a thing. Reverse engineering is a thing. Generic medications, they basically copy paste, and it's legal. So dig, do research. How loyal are customers to your brand? We want to invest in sticky companies. So the more loyal customers are to the brand, the better. Companies like to brag about their customer retention ratios. So if you can't answer it off the top of your head, let's say you are looking at Palantir, or you are looking at SoFi, or you are looking, at Afrimat, any company where you say, I don't know this company. It's not like Apple, where I know, it's a cult. Everybody is like Apple crazy. There you can answer the question off the top of your head. But if it is a company that you don't know, go into their presentations and go into their 10Ks. They brag about their customer retention ratios. You will be able to see how loyal customers are to the brand. The more loyal, the better. Switching cost. Switching cost is how easy or hard is it for your customers to leave the business. Think about retailers. If you are in a mall and you need to buy a black t-shirt, you can choose Pick and Pay Clothing over Woolies in a heartbeat. Okay, it's easy to leave. But think about software companies. If you've built your entire business on Microsoft, okay, or on iOS, software companies are not that easy to leave. So Palantir is another company that I really love. Not easy to leave. If you've built your own business from the start on that software, it's not easy to leave. So any company that you are invested in, check in your portfolio. How easy is it for customers to leave my company? The next question, I always talk about sticky companies. Does the company have recurring revenue? And this is where we capitalize on humans being humans, okay? Clients, if a company has recurring revenue, if you have a debit order going off your account every month, you are less than likely to cancel it. So insurance companies, banks that have recurring revenue, your software companies, even if you didn't know this, Tesla, if you compare Tesla to another motor vehicle company, if you buy a BMW and you include the service plan, you pay it, you are done with BMW, you never have to pay them again. You go and service your car every year or every 15,000 kilometers. You never pay for it. It's included in the plan. What Elon does is he never sells you a Tesla battery. Okay, so you rent the Tesla battery, you buy the car, you pay your 50,000 or 100,000 US dollars, and you rent the battery. So there's always that recurring revenue. Also, the software that connects you to the car, you pay forever. We love sticky companies because humans don't like to change things. Now, size matters. How big is the company? Guys, if this castle or company or city, whatever you want to call it, the bigger it is, the harder it is to attack. So stop filling your portfolios with only small companies. There's nothing wrong with being a micro cap or small cap investor, but then you need to take the risk that when you get attacked, everybody gets attacked. So look at your portfolio and look at size. It's not easy to attack Amazon. It is not easy to attack BHP Billiton. It is not easy to attack ShopRite. It is not easy to attack Standard Bank. So you must have fighters in your portfolio. Size matters, whether we want to admit it or not. Okay? Is the company a big disruptor? Disruptors have a tendency to grow very fast. So if you can find disruptive companies at the start of their journey, go for it. Just be very careful. You cannot have only disruptors in your portfolio. We look at all these questions together. Now, there are two yellow blocks. I think they are yellow, or green blocks on here. And they are the two questions that I don't want you to answer off the top of your head. And that is, does the company sell a unique product or service? The very first question. And then this question. Do not answer it off the top of your head. Is there massive room for growth? Go and dig. When I say massive room for growth, I mean, is there potential for new products or services? Okay, is there potential to go into new markets, new geographies? As soon as a company mentions, if I see like Celsius as a company that I own that makes energy drinks, calorie burning drinks in the United States, they're really big in North America. The thing that pops into my head is, this is an amazing company. I've answered all the other questions. Now I'm looking at growth. I'm like, I don't know Celsius and I'm from Africa. Then I go and dig. Do they have plans to go into Africa, to go into Europe, to go into China, to go into, there's so many untapped markets. I can't make the assumption that they will, but I can tell you now, I've done the digging. So I know what Celsius is planning next. So always, the other thing that you can look at is something called optionality. And that is where a company potentially has, let's say the company has 10 different products or services that they offer. And most of the customers of the company only has 1 or 2 products. That means there are optionality. It means that company doesn't have to grow its amount of clients, but what it can do is it can sell, cross-sell. It can sell a company like Lemonade, for instance. Let's say it has renters insurance, it has car insurance, it has all different types of insurance, but most customers have 1 product only. So with the correct marketing campaign, they can cross-sell, and we call that optionality. The company can grow without a massive marketing budget. They can use their current client base. Then the last question, and this is a nice to have, it's not a necessity, is does the company have first mover advantage? It doesn't have to be, something massive. It could be the company is doing something small differently from everybody else in that industry. And that gives them a first mover advantage, together with disruption and being a first mover. You might have found a company that can give you exponential growth. But again, you can't find a first mover without answering all the other questions. It's a combination of everything. So I just quickly wanted to explain the moat. I will dig deeper every time I analyze a company or I dig into a company on this channel. I am going to answer each and every one of these questions, and I am going to score the companies, and we are going to rip companies apart one by one. So thanks for watching. I just wanted everybody to have a starting point, in terms of understanding a business, and we'll dig into this much, much deeper every single time we talk. Enjoy. Don't forget to subscribe and like and all that other funny things.